I'm 3 months into investing and I try to explain value investing with a stool. I think I might have lost the plot. Welcome back to the Part-Time Investor, now with improved audio. The quality of the videos is still probably questionable, but at least the audio is half decent. So I've been continuing to invest into my portfolio this month, and I've come to the conclusion that I've got some half decent, solid, dependable companies in there now. But I now want to look for some real growth or value investments to add to my portfolio. I'm not hitching my wagon to any one investing strategy just yet, so I'm going to be looking for any particular growth or value stocks or dividend growth stocks or whatever I come across that I think may be able to perform better within my portfolio. I don't want to be constrained by any one methodology or set of rules just yet. I feel that I'm in a place where I'm able to start taking some bigger risks within my investment portfolio. I already pay into a decent pension every month. I pay into my house and overpayments on mortgage every month, and I'm saving. So I want to be able to use this investment pot as that higher risk area, and currently it's probably quite safe. So that being said, I've been looking into value investing this month, and I thought before I show you the stock that I bought that potentially is a bit of a value stock, I'm going to go over the basics of value investing, as this is a beginner channel. Hopefully if you do know what it is, then you might pick it up, or you may have never seen it described using a stool before. So what you're doing when you're value investing, well, you're looking for a company that is mispriced, either because people have misunderstood the financials of the business or misunderstood the fundamentals of the business. And I'm going to show you that hopefully with a tortured metaphor of a stool. So we're in a shop, which is the stock market, and we're looking at different companies, which in this case are stools. And we're walking past all the fancy bar stools, and they're all chrome plated, and maybe they're £100. And when you have a look at them, that's possibly fair value. Maybe they're overpriced, I don't know. But you don't see a lot of value added to them. Maybe they'll do well, maybe they'll not, but there's not a lot of additional value you can get from that stool. And you continue to walk past, and then you see something else that maybe is on sale. And we come across this stool. Now, when you first look at it, it looks a bit battered, it's got a bit of paint on it, and most people are walking past this stool because, I don't know, maybe it doesn't go with their kitchen. They're looking at all the other shiny stuff. But you, as a value investor, you see that this is on sale, and this is actually £5 compared to the £100 that the other stools are costing. So you go in and take a closer look, and there's a few things that value investors are looking for when they're trying to see whether this is actually something that's of value or not. Okay, so I'm going to put it down because it's quite heavy. So as a business, there's a couple of things we look for, and the first one is what's the business's moat? So what's its competitive advantage? So you might look at this and say, well, it's a hardwood solid stool. All the other stools are made from chipboard nowadays. They're not going to last long. But this will last for years, so maybe that's its competitive advantage. If you're looking at a company, maybe it has a very decent cash flow, a great brand, loads of patents that it is be able to hold on to and sell to other people, or people can't come in and take its market share, something like that. So that's the first thing we look for. The second thing we look for is, do you understand the business? So when we're looking at this stool, we know the purpose of it is to be sat on. So one, does it deliver on that job? Is it going to break? Is it useful for that purpose? Now, some other people may be looking at it and think, maybe it doesn't go in my kitchen because it's a bit ugly. So they don't see the value of it. But you understand that this stool is in the business of being sat on. That's what it's there for, and it does that job very, very well and dependably. Next thing you might look for is there a decent management in place? So is it going to be left out in the rain? Is it going to be looked after? If it's not, if it's going to deteriorate, then again, possibly not something you want to look after. But you speak to the owners, they've looked after it well, they're going to paint it up, they're going to make it look great. You can see there's potentially some growth there. And the fourth point is it on sale for an attractive price? If this was on sale for £95 and all the other stocks were £100, then maybe it's not really worth it. All that value is already baked into the price. Everyone else has seen the value of it. It's no longer a value stock. It's already priced as it should be in the market. But everyone else, because it's got a bit of paint on it, it looks a bit tatty, Everyone's walked past it, they haven't looked into it, they haven't seen the value. It's on sale for £5. That's a value investor's dream. So after considering all those points and probably quite a few others, we decide to invest in this stool. When you invest in value companies, a lot of people are going to disagree with you, because if everyone agreed with you that it was a great value company, it would very quickly not be a value company anymore and it would be priced in. So after considering all that, we invest in this stool, and after what could be a period of years or months, bibbidi bobbidi booyah, then we have this stool, and everyone is thinking, actually, it's not a bad looking stool now. I think it's worth 50 quid or 100 quid. And that's when the price goes up and you make your money. And hopefully it continues to make money year on year, and you can hold it forever and continue to increase your profits. That's a heavy stool. And that would have been a great value investment. But an alternative to that is that it could have been a value trap. So say we had bought this stool and actually it's a bit rotten and it's got woodworm, and so the fundamentals of the stool no longer stack up. If you're going to sit on it, it's going to break, it's going to deteriorate, it's no longer fit for purpose. So you could look at it and think, £5, wow, that's great, all the other stools are £100. And you buy it and then it breaks because it's actually rotten. That's a value trap. So it's difficult sometimes to tell what's a value trap and what's a value company. And again, like I say, if everyone agreed with you, it would no longer be a value company. So you have got to think almost opposite to what the rest of the market is thinking. And sometimes you'll win and sometimes you'll lose with value investing, and hopefully you win more times than you lose. And that, ladies and gentlemen, is value investing using the tortured metaphor of a stool. And if you're one of the 80% of people who are watching this that haven't liked and subscribed, I mean, what more can I do? If you really want to see more tortured furniture investing metaphors, just go ahead, give me a little like, a little subscribe, and next week, who knows, maybe I'll explain growth investing using a wardrobe. Okay, so let's dive straight into some of my recent purchases. So this month, I've mainly just increased my ETFs. I'm trying to get it to about 50% of my portfolio, currently sitting about 45%, slowly building that up to 50%. Hopefully next month, by month 4, I'll have 50% equal between my ETFs and my stocks. So the only two stocks I've bought one is Intel. Now, Intel is the potential growth stock that I was talking about before, and I'll just go into some of the reasons why I think it might be, and also why it might be a value trap. I've been having a look at Intel over the past couple of weeks, and I was quite impressed with the kind of financial information that I was looking at, but I hadn't invested in it until the stock market price dropped on Friday. It dropped by about 15%, and although I hadn't fully decided whether I was going to invest in it, I just thought, actually, nah, it feels like it's on discount now, I'll jump in. Whether that was the right decision or not, well, we'll have to wait and see. So if we have a look at some of Intel's figures, I mean, its current price to earnings ratio is just over 12, and when you compare that against some of its competitors like Qualcomm, which is over 50, and AMD, which is about 145, it looks quite cheap. And even when you have a look at its PEG ratio, and if you want to know about the PEG ratio, I mention it in my previous video looking at 5 stock picking fundamentals, then again, it seems to look good against its other competitors. So if we continue to have a look at some of the figures, it's got a dividend of 2.16, which is very decent again in the tech sphere. A profit margin of nearly 30%, so again, very decent. And obviously Intel is still the king of chips. If you have a look at your laptop, almost certainly it will have an Intel sticker on it. If you have a look at your desktop computer, almost certainly it will have an Intel sticker on it. It has about 90% of the market share. But its competitors like AMD have been making strides into its market share and just chipping it away. For instance, recently Apple has moved away from using Intel's chips. Intel never managed to break into the smartphone market, which is now dominated by companies like Qualcomm, and potentially Qualcomm is moving into the laptops market. I believe that Lenovo are currently looking at using some of Qualcomm's chips within their laptops. Again, that could be taking some of Intel's market share. So there's certainly reasons why people think that Intel is on the way down. It has been having issues, and its latest one is that it's had to delay its release of its latest chip for another 6 months, and that's why its stock price dropped by over 15% on Friday. Who knows where it's going to go? I believe that it still has a very decent market share. It can pull back from this, and its financials currently look very, very good. The only problem being that if it starts to lose market share, then it's going to go down in value eventually. I hadn't fully done all of my research. I was still having a look at it when the price dropped. I thought I had to kind of jump onto that, and I only opened a small position in it, 2 shares worth about £80. As I kind of settle on my mindset around Intel, I'll either increase it or probably just leave the current £80 there to sit for a while. We will see. The other investment I made this month is in Visa. It pretty much has a duopoly of card processing payment services with MasterCard. Now, I did have a look at Visa comparing to MasterCard, and Visa seemed to come out best. Visa had a PE of 36 against MasterCard's 39, and it also had a PEG of 3.09 against MasterCard's 3.8. So against some of their metrics, it does look better. It's recently invested in a tech startup called Plaid, not sure exactly how it's pronounced. I'll put it down there somewhere. And that's a tech company that was looking at APIs and linking different financial instruments together. So they are looking to move into that sphere. Also, they are working with the likes of Facebook on payment processing within WhatsApp. There's a lot of stuff that's going on there. Again, payment processing surely is going to get bigger and bigger and bigger. We're all going to be going towards a cashless society eventually. It's going to be accelerated with the likes of the coronavirus. So I can only see Visa growing. Whether all that's baked in or not, I don't know. But I thought I'd get in and put a small proportion down there. I've only really gone for half a share on that. Normally I like to go for full shares, but I just kind of tested the waters with half a share with Visa, and we'll see where we go with that. And they're the 2 additional stocks that I've bought this month that I've added to my portfolio. So all in all, I've invested over 3 months £3,160, and I'm currently up by 4.24%, so I have made £133, not including any shares that I've sold, which amounts to about £20, and also not including any free shares. Actually, talking about free shares, this month I got a free AstraZeneca share worth about £94. So, a couple of videos ago I was talking about whether the Trading 212 actually gave you shares that are worth nearly £100. Well, clearly they do, and whoever signed up, I'm sure they were pretty glad that they got the AstraZeneca share as well. Imagine if you only put in £1,000, then you're already up 10% straight away on day one. So if you are looking at setting up a Trading 212 account and you want a free share, please click the link below and sign up using that. And as long as you put £1 in, you will get a free share worth up to the value of £100, which we know is true. And I also get that free share, so it helps me out as well. Why not start your investment journey with a little bit of free money? Anyway, I hope you enjoyed this video. That's it from me. See you later.